It is a mistake to try to look too far ahead. The chain of destiny can only be grasped one link at a time. That's a quote from Sir Winston Churchill, and it really sets the tone, doesn't it? Thinking about long-term focus, especially in finance. It speaks, I think, directly to that steady approach needed for something like income investing. Welcome to the Deep Dive. We're here to distill complex financial information into clear, actionable insights for you. Today, we're diving into what we think is a really valuable topic, especially if you're looking for solid financial knowledge. This deep dive is for the Finbot Insights YouTube channel, focused on helping you make informed financial decisions. So our main topic today, dividend investing. We're covering the foundational principles, but also digging into some advanced considerations. Think of this as, well, a shortcut for you, the retail income investor, to get really well informed about generating consistent cash flow from your investments. We want you to clearly understand how businesses can provide those frequent cash payouts through owning their stock. It's a distinct advantage, really.
Absolutely. And our mission here is pretty specific. We want to dissect the mechanics, look at the history, cover the benefits, but also, frankly, talk about the risks. We'll also touch on some specific strategies related to dividend-paying stocks. The goal is to give you, the income-focused investor, a clear, structured understanding so you can make informed decisions for reliable cash flow and ultimately long-term financial stability. We're going to try and move beyond some common myths and really uncover the fundamental value of dividends, why they still matter, demystifying dividends for income-oriented investors.
Okay, let's start by demystifying dividends, especially for you, the income investor. At its heart, dividend investing is a pretty direct way to receive regular cash payouts from your stock investments. A dividend stock is simply one from a company that chooses to distribute a part of its profits, could be cash, sometimes more stock, directly to its shareholders. And this usually happens regularly, quarterly or sometimes even monthly. A consistent income stream.
Right. And the mechanism behind it, these companies, they distribute a portion of their profits, but they also reinvest the rest back into the company. That reinvestment is crucial for fueling future growth, keeping things stable. There's a key metric called the payout ratio. It's just the percentage of the total profits they pay out as dividends. Now, companies that can do this regularly, consistently, they need to have really stable cash flow and enough profit beyond their operating costs and debts. It signals financial strength.
That makes sense. And providing those regular payouts, it implies a certain fiscal discipline, doesn't it? That kind of discipline usually develops over many years. It's not something you see in brand new companies. You contrast that with startups. I mean, the statistics show something like 80% fail within their first 5 years, which makes them generally unsuitable, really, for income investors who need that consistency. Stability is key.
Exactly. And the historical evidence backs this up. Dividend-paying stocks tend to be inherently less risky, and they generally produce more income over time than non-dividend payers. Their maturity, their stability, their proven profitability, it helps them hold up better even when the market takes a downturn. It comes down to having robust cash reserves and that long-term endurance. For you, the income investor, that means potentially less volatility. B, the allure of dividends versus speculative behavior.
Now let's talk about something we see a lot. Speculative behavior among individual investors. People often get influenced by, market noise, the talking heads on TV, jumping in and out of the market, especially when it reverses quickly. Well, that often leads to losing significant portfolio value. Data shows frequent traders often do worse than those who just hold on longer. You risk missing out on that long-term market average return, maybe 8% or so annually, because of trying to time things perfectly.
Yeah, it's a common pitfall. And this is where dividend stocks present a really appealing alternative. They offer two potential ways to gain: share price appreciation, like any stock, and those direct cash payments without needing to sell. Stock prices bounce around daily, which can be stressful. Dividend payments, though, tend to be much more stable, predictable, tangible income.
That's a crucial distinction, the cash value idea. If you invest in a stock that doesn't pay dividends, it's arguably more speculative because you get zero cash unless you sell the stock itself. You're completely reliant on finding a buyer at a price you like, dependent on market conditions at that exact moment.
And if you look historically, the U.S. stock market has changed quite a bit. From its early days through the mid-20th century, most U.S. stocks actually paid dividends. It was the norm, a reliable income source. But then, starting in the 80s and 90s, with the rise of NASDAQ and the tech boom, non-dividend stocks became much more common. More fashionable, perhaps. Just look at the numbers. By 2021, only about 25% of NASDAQ composite companies paid a dividend. And even in the S&P 500, only 203 stocks had a yield under 1.0%, but they represented over half half the index's market cap. The percentage of S&P 500 companies paying dividends fell from 95% back in 1965 to about 78% in 2021. It signals a shift towards more of a trading market.
Let's use a concrete example. Alphabet Google, as most know it. GOGL. Hugely successful, profitable, reputable company. But it doesn't pay a dividend. It restructured in 2015, share prices soared. I mean, it went from maybe $600 in 2010 to over $2,800 by late 2021. But here's the key point for income investors. If you just buy and hold GOGL, you only see cash when you sell. There's no payout from the value it builds up.
Yeah.
And that makes you vulnerable in crashes, right? Like 2008, 2020, the dot-com bust. Tech stocks can be volatile, and you might not be able to sell when you want or need to.
Exactly. Which brings us back to some fundamental wisdom. John Burr Williams, in his 1938 book, The Theory of Investment Value, he put it very clearly. He said, essentially, a stock is worth the present value of all its future dividends, no more, no less. He argued that things like current earnings and outlook, they matter primarily because they help you estimate those future dividends. It really underscores that link between a stock's value and its ability to generate cash for its owners. For an income investor, that's fundamental.
So what's the takeaway here for you listening now? There's a big difference between that casino-style trading you see hyped up and serious long-term investing. Constant trading often comes with anxiety, stress, higher taxes from turnover, and maybe even lower returns in the end. For income investors, dividends offer something tangible, immediate, and usually less volatile. Real cash in your hand, not just hope for a higher price tomorrow. 2. The mechanics and benefits of dividend investing. A. How dividends influence total returns.
Okay, let's really dig into how dividends impact total returns. The historical data is quite powerful. Since 1926, roughly 32%, almost a third of the total market return has come directly from dividends. If you only focus on price appreciation, you're potentially missing a huge chunk of the long-term picture. And even before the S&P 500 era, pre-1957, Robert Shiller's data shows that dividends accounted for 4.7% out of an 8.7% total market return. That's more than half. It just highlights the consistent, significant role dividends have played in building wealth over decades.
And that translates into real benefits for income investors, right? Because historically, these dividend-paying stocks haven't just delivered higher returns overall. They've done it with noticeably lower volatility over longer periods compared to non-dividend stocks.
Yeah.
That's huge if stability is a priority for you. It's not just about the return, but how smooth the ride is getting there.
Precisely. And this isn't a new idea. Benjamin Graham and David Dodd, in their classic book, Security Analysis, back in 1934, they stated very clearly that dividends are the main component of long-term total return. Their view was that an investor really benefits either through dividends received or through price increases, and often the price increase depends on the dividends or the prospect of them. They actually argued investors should demand adequate dividends as a tangible benefit. It's a sign of a healthy, shareholder-focused company.
It's important to clarify, though, dividends themselves don't cause a company to be successful. Rather, they're the result, the manifestation of that success. When a company can consistently distribute profits, it shows strength and confidence. Large, established companies often distribute earnings because, well, holding on to too much cash without good reinvestment opportunities isn't ideal. Shareholders expect a return.
And external factors play a role, too. Tax policy, for instance. Remember the Jobs and Growth Tax Relief Reconciliation Act of 2003? It lowered the maximum tax rate on qualified dividends significantly, down to 15%. And what happened? Many S&P 500 companies either started paying dividends or increased their existing ones. It suddenly became more tax efficient for shareholders. So regulatory changes can definitely influence dividend policies.
Which leads to a powerful connection. Dividend growth often signals underlying business value growth. If a company consistently raises its dividend, especially if it's funded by rising earnings and cash flow, its business value tends to increase too. It's a sign of a healthy, growing business sharing its success. You want growth driven by real earnings, not just borrowing money to pay shareholders. B. The immediate and long-term benefits for income investors.
Let's just quickly define yield clearly. It's simply the return an investment provides, expressed as an annual percentage of its current price. For dividend stocks, you calculate it by dividing the annual dividend per share by the stock's current price, a fundamental metric for income.
And this is where it really hits home for you, the retail income investor. Dividend stocks offer that reliable income stream. Non-dividend stocks just don't provide that. It's incredibly important, especially if you're in or nearing retirement and need that cash flow to live on.
Let's paint a picture. Imagine a retiree needing $2,000 a month. If their portfolio yields only 2.0%, they'd need about $1.2 million in assets. But if they build a portfolio yielding 3.5%, They'd only need around $700,000 to generate that same $2,000 monthly income. That's a massive difference. A higher yield means you might need significantly less capital to achieve financial independence, or you could reach it sooner. It takes pressure off your principal.
And this is especially relevant today, isn't it? It's getting harder for retirees to find reliable income. Yields on traditional safe havens, money markets, CDs, even many bonds have been low, often not even keeping up with inflation. Meanwhile, the cost of living, especially healthcare, keeps rising. In this kind of environment, dividends look increasingly attractive, almost essential as a source of regular cash flow.
But, and this is critical, it's not just about any dividend. It's about sustainable dividend growth. You need to look for companies increasing dividends because their underlying earnings are growing. Strong cash flow is key. Beware of companies funding dividends through excessive debt or unsustainable means. That's like living off credit cards. It doesn't end well. You want genuine financial health backing that payout.
Okay, let's quickly summarize the core benefits for income investors. First, obvious one, regular passive income.
Yes, a steady stream you can reinvest to compound growth or use for expenses. Very appealing, especially for retirees.
Second, the companies themselves tend to be more stable.
Generally, yes. More mature, more accountable than high-flying startups. Management might be less prone to taking huge risks.
Third, potentially lower risk because you have two ways to profit.
Right. Share price appreciation and cash payments. They often have lower volatility in downturns, the dividends acting as a sort of cushion.
Fourth, you get to keep your stock while collecting profits.
Huge benefit. You participate in long-term growth and get cash along the way. Unlike non-dividend stocks where you must sell to realize gains.
Fifth, you receive cash you can use to buy more shares.
The power of compounding through dividend reinvestment plans, or DRIPs. Your investment grows faster without you adding new money.
Sixth, potential for positive returns even in down or flat markets.
Absolutely. If the dividend payments continue, they can offset price declines, giving you some return while you wait for recovery, pays you to be patient.
And finally, dividends can act as a hedge against inflation.
That's right. Companies that can raise prices often see higher earnings, which can lead to higher dividends, helping your income keep pace with rising costs. 3. Navigating the dividend calendar and understanding risks. A. Understanding dividend dates. All right, let's get practical. Understanding the dividend calendar is essential if you're relying on this income. There are 5 key dates you need to know. First is the trade date. Simple, the day you actually buy or sell the stock. Then comes the settlement date. Usually 2 business days after the trade date, T+2. This is when the transaction finalizes, money changes hands, and you officially become a shareholder of record. Think of it like closing on a house.
Okay.
Now, the really crucial one for getting paid, the ex-dividend date. This is the first day the stock trades without the upcoming dividend. If you buy before the ex-dividend date, you get the next dividend. If you buy on or after it, you don't get that specific payment. The seller does. You have to wait for the next cycle.
Got it. Timing is everything there.
It is. Then usually 1 business day after the ex-dividend date is the record date. This is the date the company checks its records to see who officially owns the stock and qualifies for the payment. And finally, the pay date. That's the day the dividend actually gets paid out to the shareholders who were on record. Cash in your account or reinvested.
So, trade date, settlement date, ex-dividend date, record date, pay date. Knowing that sequence helps you plan your income and make sure you actually get the dividends you're expecting. B, acknowledging the risks of dividend investing.
Now, while dividend stocks offer stability, let's be clear, they aren't risk-free. No investment is. Share prices can still fall, market downturns, company-specific issues. They can impact dividend stocks too. And in a worst-case scenario, a company could go bankrupt. Just like any other stock, you could lose your investment.
Right. And there's another key risk, unique to dividends compared to, say, bonds. Companies are not legally required to pay dividends. Unlike bond interest, there's no default if they cut or stop payments. They have the discretion to reduce or eliminate dividends entirely if finances get tight or strategies change. That's a major risk for income investors.
It absolutely is. And when a company does cut its dividend, it's often seen as a major red flag about its financial health, frequently leading income investors to sell the stock. So monitoring dividend safety is crucial. 4. Elite dividend performers. The dividend aristocrats. A, defining and identifying dividend aristocrats. Okay, let's talk about a really interesting group, the dividend aristocrats. This is a sort of elite club within the S&P 500. These companies are recognized for incredibly consistent dividend growth and strong long-term performance. In 2021, there were 65 companies on this list.
Dividend aristocrats. Sounds prestigious. What does it take to get into this club? Are the criteria tough?
Very tough. Three main requirements. First, you have to be in the S&P 500 index. Second, and this is the big one, you must have increased your dividend every single year for at least 25 consecutive years.
Wow, 25 years straight of increases through recessions and everything.
Exactly. And third, you need a minimum market cap of $3 billion at each rebalancing, ensures they're large established companies. So typically, these are large cap, blue chip names across various sectors. Think stability, strong business models, consistent earnings growth, that's what allows them to maintain those long dividend increase streaks. B, historical performance and sector representation.
And how have they performed? Does being an aristocrat translate into better returns?
Historically, yes. For the decade ending 2019, the Dividend Aristocrats Index returned 14.75% annually, compared to 13.57% for the S&P 500. So they outperformed by over 1% per year. And remember, dividends made up about 20% of the market's total return during that period, highlighting their contribution.
Interesting. What kind of companies are typically on the list? Which sectors dominate?
As of late 2021, the top sectors were consumer staples, about 20%, industrials, around 19%, and materials, roughly 13%. Financials and consumer discretionary were also well represented. You see less representation from sectors like telecoms, utilities, and IT, only around 2% each. It reflects where that consistent long-term profit growth has historically been found.
Any famous examples we'd recognize?
Oh, definitely. Think household names like Coca-Cola, KO, Johnson & Johnson, J&J, Procter & Gamble, PG, all with streaks over 59 years. And then you have companies like Dover Corp, DOV, and Genuine Parts Co., GPC, tied at an incredible 65 consecutive years of dividend increases. Just remarkable consistency. See resilience through market cycles. It's interesting to see how the number of aristocrats changes over time, especially around major bear markets. Tough economic times like the 70s downturn or the dot-com bust forced many companies to freeze or cut dividends, knocking them off the list or preventing them from qualifying later. The list peaked around 2001 and 2008, but the recessions that followed saw numbers drop again. It's a real test of resilience.
What about the COVID crash in 2020? How did they fare then?
It was another test. A few, like Ross Stores and Helmerich and Payne, did cut their dividends and fell off the list. But others, like IBM and Nexter Energy, actually joined the list, having hit their 25-year mark. So the total number stayed stable at 65.
So it shows adaptation within the group. Some fall, some rise.
Exactly. It highlights the overall resilience. Achieving that 25-year streak is hard. Only about 13% of S&P 500 companies make it. It really points to strong, consistent business models, significant competitive advantages those moats, and excellent capital management.
And do the financials support that claim of robustness?
Yes. For example, the average return on assets, ROA, for aristocrats was 8% as of late 2021, which was 20% higher than the S&P 500 average. Shows better efficiency. Plus, many are the largest companies in their industries, or rank in the top 3. They're clear market leaders.
So strong fundamentals, strong performance.
Generally, yes, although it's fair to add a recent nuance. While they historically outperformed on a total return basis, including dividends, they did slightly lag the S&P 500 in the period ending September 2021. That was largely due to the massive run-up in a few giant tech stocks that don't pay dividends. Think Alphabet, Tesla, Amazon, Apple.
Okay. So market leadership can shift, even away from traditionally strong performers. Good context to have. V common versus preferred stock. A deeper look. A distinguishing features. Okay, let's shift gears slightly and look at two different types of stock. Common versus preferred. Important distinctions for income investors. Common stock is what most people think of when they hear stock. It's the most prevalent type. As a common stockholder, you might get dividends, usually variable, decided by the board. You typically get voting rights. And you hope for capital appreciation, though the value fluctuates.
Right. Now, preferred stock is different. It tends to be less volatile than common stock, but usually offers less potential for big price growth. It often acts a bit more like a bond. Key differences. First, preferred stockholders usually don't get voting rights.
Okay, no say in the company.
But in exchange, they have a higher claim on the company's assets. If the company goes bankrupt, preferred holders get paid back before common stockholders.
So they're preferred in the payout order during liquidation.
Exactly. And also for dividends. Preferred shareholders must receive their dividends before any dividends can be paid to common stockholders. Plus, preferred dividends are often fixed at a certain rate for a set period, making the income stream more predictable than common dividends, which can vary.
So higher priority, often fixed payment. Sounds good for income. Any catches?
Well, the payment still depends on the company's ability to pay. They can suspend preferred dividends if necessary, though it's usually a last resort before impacting common. And a big one is callability. Many preferred stocks can be called or bought back by the issuing company after a certain date, usually at face value.
Meaning they can take your high-yielding preferred stock away if interest rates fall.
Precisely. They might call it back to reissue new preferred stock at a lower dividend rate, leaving you needing to reinvest your money at potentially less attractive yields. So that's a risk to be aware of.
Okay, so common stock offers growth potential and voting rights, but dividends are variable and lower priority. Preferred offers higher, often fixed dividends and higher priority, but usually no voting rights, less growth potential, and call risk.
That's a good summary of the main trade-offs.
So choosing between them really comes down to your individual needs and goals, doesn't it?
Absolutely. Your time frame, your tolerance for risk, whether you prioritize income stability or growth potential. A retiree might favor preferred for income, while a younger investor might lean towards common for growth.
And as always, consulting with qualified financial planners and tax advisors is smart, as the tax treatment can differ too. Outro.
So wrapping things up, the core message from our deep dive today is this. A diligent, informed approach focused on high-yielding, dividend-growing stocks can deliver solid, risk-adjusted returns over the long haul. Dividends provide that consistent cash income like paychecks from your investments, which is a really tangible benefit, especially if income is your main goal. It's about building a portfolio that works for you.
And as a final thought for you to ponder after this discussion, we've seen this historical shift away from dividend-focused markets towards more speculative growth. What might be the broader economic implications if tangible cash flow from owning businesses becomes less common, and value gets increasingly tied just to what the next buyer might pay? Something to think about regarding the nature of value itself. Thank you so much for joining us for this deep dive on dividend investing presented for the Finbot Insights YouTube channel. We truly hope this discussion has given you valuable insights to help you make smarter financial decisions. If you found this deep dive helpful, please do click that like button on the YouTube video, and be sure to subscribe to Finbot Insights for more in-depth analysis designed to empower your financial journey.